Welcome back to Iron Financial. We're here to help you forge a stronger portfolio by stress testing the market and cutting through the weakness. Today, we're putting Planet Fitness on the anvil. They just dropped their Q4 earnings, and on the surface, this thing looks rock solid. But the stock? The stock got absolutely hammered in pre-market trading. This is the kind of disconnect we live for. A healthy-looking report, but a sickly stock. So the big question is, what's really going on under the hood? Did the market spot a fatal crack in the foundation, or is this just a classic overreaction, creating a potential fire sale for investors with a strong stomach? Let's get to work. All right, let's start forging this thing piece by piece, beginning with the headline numbers. First up, earnings per share, or EPS. Now, for anyone who's not deep in the weeds on this, think of EPS as the ultimate bottom-line scorecard. It tells you exactly how much profit the company is cranking out for every single share of its stock. It's the purest measure of profitability. Planet Fitness reported 83 cents a share. The forecast from Wall Street, only 78 cents. That's not just a beat, that's a solid beat. A clean win on the bottom line is the first thing investors look for. It tells you management is running a tight ship. So far, the structure looks sound.
And it's the exact same story when we look at the top line, the total revenue. This is the raw power of the company's sales engine, before any costs are taken out. They pulled in over $376 million. Crushing the forecast of about $367 million. So let's just lay this out clearly. More sales than expected and more profit than expected. This tells you the company is successfully executing its game plan, bringing more cash in the door and keeping more of it. With a clean sweep, a beat on both revenue and earnings, you'd naturally assume the stock would be taking off like a rocket, right?
Yeah, you would think. But that's not what happened. Not even close. Instead, the stock got crushed, dropping over 5% before the opening bell even rang. And this, right here, is the core of our investigation today. So let me get this straight. You outperform expectations on sales, you outperform on profits, and your reward is a punch in the gut? That makes absolutely no sense on the surface. That is a massive red flag. The market is basically shouting from the rooftops that it does not care one bit about these strong numbers from the past. It has sniffed out something else in this report, something that's making it seriously question the future durability of this company.
Exactly. A strong report, a weak stock. This is the entire puzzle we need to solve. What is the market seeing that isn't obvious from the headlines? Is there a fundamental crack in the company's foundation? Is this strong past performance just a fresh coat of paint slapped over a crumbling structure? Or is there a very real, very tangible problem buried deep in the footnotes of this report, specifically in the company's forecast for the future? We have to understand this disconnect. We have to figure out if this is all hype and fear or if there's a real problem here.
And that's exactly what we're going to do. We're putting Planet Fitness through a full-scale structural analysis right now. Here's our game plan. First, we'll hammer down the details of the disconnect. Second, we'll start forging the top line, making sure those past results are as solid as they look. Third, and this is the main event, we're checking the core framework. That's the guidance for the future. Fourth, we're going to go looking for cracks in the armor, searching for any other weaknesses. And finally, we'll weigh all the evidence and deliver the iron financial verdict.
Okay, let's jump right in. Section 1, the disconnect. The single most important thing to get your head around is that the stock market is a forward-looking machine. It doesn't really care about what happened yesterday. It's all about what's going to happen 6, 12, 18 months from now. The entire meltdown in the stock price is rooted in this fundamental conflict between a very strong past and a guidance that suggests a much weaker future. Our job is to figure out if the market's fear is a justified reading of the risks, or if it's just a panic attack creating an opportunity.
So let's move on to Section 2. Before we can even start talking about the future, we have to be 100% certain about the strength of the present. We've got to pressure test these Q4 results and confirm they're built on a solid slab of concrete, not financial quicksand. We're going to start with the most visible part of the structure, that top-line revenue growth.
And just look at this chart. The revenue growth is undeniable. We're talking about a 10.5% jump in sales compared to the same quarter last year. Look, in any economy, that's impressive. But in this economy, with all the uncertainty out there, seeing double-digit top-line growth is a massive sign of strength. That doesn't happen by accident. It shows a powerful, scalable business model that is firing on all cylinders. You can't argue with this number. It is what it is. Impressive.
And what's really encouraging here is that this strength isn't just coming from one place. The growth is broad-based. It's coming from every single segment of the business. Their franchise segment, which is really their bread and butter, grew by a super healthy 9.6%. The gyms they own themselves were up 7.4%. And then you look at their equipment segment. This is when they sell treadmills and ellipticals to their franchisees. That division exploded, up a massive 15.3%. This is what comprehensive strength looks like. Every part of the engine is pulling its weight.
Okay, but hold on a second. Let's drill down into how they're growing inside their existing gyms. This same club sales number is critical. A 5.7% increase is healthy for sure, but look at where it's coming from. A massive 80% of that growth came from what they call rate growth. Let's be honest, that's just a fancy term for price hikes, specifically upselling people to their more expensive Black Card membership. Only a tiny 20% of that growth came from actually adding new bodies to those existing gyms. So are they really expanding their customer base at these locations, or are they just squeezing more money out of the members they already have? That feels fragile. How long can that be your main growth engine? It doesn't seem sustainable.
That's a fair challenge. That's a very sharp point, and we need to address it head on. So what's behind that rate growth? This number right here, 66.5%. That's the percentage of their total members who are now paying for the premium Black Card plan. That is an all-time record for the company, and it's up significantly from last year. So yes, a huge chunk of the growth is coming from higher prices, but it's not because they're just jacking up the price of the basic $10 plan. They are successfully executing a strategy to convince a massive portion of their customers to upgrade to a premium product. The fact that 2/3 of the members are buying in tells me that the value proposition for that Black Card is real, and their brand loyalty is incredibly strong.
And to your point about bringing in new people, let's not lose sight of the bigger picture here. The overall membership base is enormous, and it is still growing. They wrapped up the year with nearly 21 million members. They added 1.1 million net new members throughout the year. On top of that, they're expanding their physical footprint like crazy, opening a record 104 new gyms in the fourth quarter alone. The company is getting bigger, the foundation is getting wider, and they are absolutely bringing new customers into the fold. So our inspection of their past performance holds up under pressure. The Q4 report was undeniably solid,
which means if the past is so strong, the problem has to be in the future. And that brings us to the absolute heart of the matter, the real reason the stock took a nosedive. Section 3, checking the core framework. We are now moving from the shiny exterior of the Q4 report to the internal support beams, the 2026 guidance. This is what spooked the market. This is where we need to look for those stress fractures.
And there it is, in black and white. This table is the smoking gun. This is why the stock got hit. Just look at the slowdown across every single critical metric. Full-year revenue growth is guided to slam on the brakes, dropping from 12% down to about 9%. Same club sales, which we just said were so important, are projected to fall from nearly 7% growth down to a range of just 4 to 5%. Adjusted EBITDA, a key measure of profitability, is cooling off from 13% down to 10%. And the one that matters most to shareholders, adjusted EPS growth, it's getting sliced almost in half, from a monster 19% last year to a guided range of only 9 to 10% for this year. The market sees a high-growth company hitting a wall, and it's repricing the stock for that new reality.
Okay, so the obvious question is why? Is the core business starting to rust? Well, on the earnings call, management was very clear. They pointed to two very specific structural reasons for this slowdown. First, they're intentionally changing the equipment replacement schedule for their franchisees, which means they'll sell less high-margin equipment this year. Second, they sold off 8 of their corporate-owned gyms. That revenue now becomes a lower-margin royalty stream. Management says these two things alone are a major headwind to their growth numbers. They're trying to frame this as a planned, controlled demolition, not a surprise collapse.
But then they roll out this idea of a 3-year growth algorithm and claim this year was always supposed to be the low point. I don't know, that sounds awfully convenient, doesn't it? Is that a real pre-existing strategic plan they've been telling investors about all along? Or is that a story they're spinning now that the numbers are slowing down? It sounds a little like someone saying, "Oh, that giant crack in the wall? Don't worry, we meant for that to be there. It's structural." I'm not convinced this isn't just an excuse for a business that's hitting a natural ceiling.
That is the million-dollar question, and it's exactly the question a skeptical investor should be asking. So, for the sake of our analysis, let's assume we don't buy their explanation at face value. That takes us to Section 4, cracks in the armor. We're now going to actively hunt for other potential weaknesses. What are the other outside pressures or internal vulnerabilities that could be causing this slowdown? Things management isn't talking about.
Well, they list the usual risks in their reports. Market saturation, competition, the standard stuff. But one of those risks, economic uncertainty, isn't just corporate jargon right now. It's very real. People are feeling the squeeze. When the price of gas and groceries goes up, people cut back on things they don't absolutely need. Now, a $10 gym membership, that's probably pretty safe. But what about that premium $25 a month Black Card that's been driving all their growth? That feels like a very obvious place for a family to cut back if things get tight. That's a real vulnerability.
That is a completely valid point about the health of the consumer. It's a major risk. But this number right here is an incredibly powerful counterargument, 34.8%. At the end of last quarter, nearly 35% of all new members were actually rejoins. These are people who were members, they quit for whatever reason, and then they came back. This is a hugely important metric that often gets overlooked. It tells you everything you need to know about brand loyalty and the stickiness of their model. Even when people leave, probably for those exact economic reasons we just talked about, a huge number of them make a conscious choice to return when they can. This suggests the business model is incredibly resilient. It's a flexible structure that can bend under economic pressure without snapping.
Okay, we've run the stress test, we've inspected the foundation of their past performance, we've examined the weaker framework of their future guidance, and we've gone looking for any other cracks in the armor. It's time to put it all together. Section 5, the Iron Financial Verdict.
So here it is, the final balance sheet of our analysis. In the strengths column, the assets are formidable. You have an incredibly powerful brand with a proven capital-light franchise model. They have record-high Black Card penetration driving profits. They are still posting solid member and new club growth. And that insanely high rejoin rate acts like rebar in the concrete, providing incredible defense against customer churn. On top of all that, the business is a cash flow machine, and they're using that cash to buy back their own stock. But the weaknesses on the right are real and cannot be ignored. The number one issue is clearly decelerating growth. There's no doubt they are heavily reliant on those rate hikes. They are facing known, self-inflicted structural headwinds. And there are always external market risks and rising interest expenses to worry about.
So, our analysis leads to one clear conclusion. The market punished Planet Fitness for its 2026 guidance, not its 2025 performance. The underlying fundamentals of the business, the brand, the model, the cash flow, appear to be solid as a rock. The structure is sound. But the market is now rightfully putting the company's future growth path under an intense microscope. The foundation appears strong, but the blueprints for the next phase of construction show a slower, more deliberate build-out, and investors are having to reevaluate what that's worth.
And that leaves us with the final critical question that you have to answer for your own portfolio. After seeing all the evidence, what do you believe? Is this slowdown the first visible sign of a serious structural failure? A crack in the foundation that's only going to get wider? Or do you buy management's story? Is this a planned, temporary, and well-communicated slowdown that is creating a long-term buying opportunity in a fundamentally sound company? To put it bluntly, is this a trap or is this an entry point? That's the verdict you have to forge for yourself. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.